Are you going to sign your mortgage loan agreement? If yes, then take a moment and pause. This could be one of the most important financial decisions of your life, and there's more at stake than just your signatures. Understanding the key terms buried within the lengthy document is crucial. Many of us just simply skim through or place their trust entirely in what their mortgage agent or bank tells them. But this approach can lead to costly mistakes down the road. In this video, I'm going to walk you through the essential terms and conditions you need to be aware of using a real mortgage agreement from a lender. I'll break all it down for you so that you can feel confident and informed before putting pen to your paper. This knowledge could save you from future headaches, so let's dive in and make sure you are fully prepared. So as I told you in the beginning, we are going to learn all these important terms with the help of an actual loan agreement. In most of the mortgage loan agreements from the different lenders, you're going to find the terms and conditions the same, but the layout may be different. So on the very first page, you are going to find the very important details. The very first one is your mortgage loan number. So that will be your account number with the lender. Along with that, you will be finding the name of the borrowers, like your name, or if you are co-buying with someone else, then all the persons on the title will appear here on the front page. Under the address of the property being used as security, you will be finding the address of the property that you are buying. Also under the legal description of the property, the actual legal description of the house that you are buying will be mentioned, like the lot number, if there is any easement on the property, things like that. The next thing you need to check is the name of your lawyer will be helping you in the closing of the property. So that you need to check is the bank or the lender is sending the instruction to the right lawyer. On the very first page, you need to check about the registered amount of your collateral charge. So in this case, it's $700,000. This amount has to be at least equivalent to your mortgage loan amount or can be more than that. So now let's understand what is the registered amount of your collateral charge. This means that you are granting your lender the right to sell your property to recover the amount you may owe to your lender if you are in default. It also means that if you want a new loan or credit agreement, the lender may be able to reuse the collateral charge to secure it. If you agree to have collateral charge registered for an amount that is greater than the principal amount, then you may be allowed to borrow additional funds later through future loans or other credit agreements. And what will be the benefit to you? That you would then not need to pay for the registration of another collateral charge, which can save you time and money. So, taking an example of this case, if the registered amount of collateral charge is increased to $900,000, then the borrower can ask for a credit of another $200,000 in the future without having the need to undergo the expenses of registration. So if we go down, so see the principal amount is $700,000. So in this case, the registered amount of collateral charge is equivalent to the principal amount. So the next thing you need to check is the annual interest rate. This is your contracted interest rate with your lender. So in this case, it's 4.66%. So if you can check just under the interest rate, it's mentioned that this rate is fixed, which means it's a fixed rate mortgage. If it would have been a variable rate mortgage, it will mention here that it's a VIRM, that is variable rate mortgage. So you need to take care of this thing, that whether you are taking a fixed rate mortgage or a variable rate mortgage should be mentioned over here. So the next thing you need to check is annual percentage rate. So if you see, there is very marginal difference between the APR and your contracted interest rate. Why? Because annual percentage rate involves any cost that is involved in borrowing the money. So normally the lender charges you an appraisal fee when you are borrowing. So appraisal fee can range from $300 to $500, but technically you just need to take care of your annual interest rate, which is 4.66% in this case. So the next important thing you need to check is the term of this mortgage, which is 3 years in this case, which means the interest rate that you have selected and the terms and conditions you are going to sign will stay valid and in force for 3 years. So the next important thing you need to check is date of advance, which is your closing day. So this is the day when the bank is going to advance you the funds. Then you are going to become a mortgage holder. So August 28th is the date when the closing is going to happen. So the next important thing is your payments. So how much you will be paying as interest and principal on per month basis will be mentioned over here. But there is another thing that you need to understand, which I'm going to explain you in detail in the very end of this video. So just watch this video till the very end to understand the concept of payments. Another important thing to check here is amortization period. In this case, it's 25 years. Amortization means how long it will take you to pay off your mortgage. If it's an insured deal, means where you are putting less than 20% down, this amortization period can only extend up to 25 years. But if you are making 20% or more than 20% down, then you can extend this amortization period up to 30 years as well. Starting August 1st, 2024, for the first time home buyers who are buying a newly built home in Canada can also extend the amortization up to 30 years, even if they are putting less than 20% down. So that's a change which has just happened in the mortgage. So the most crucial thing that you need to check in your agreement is your prepayment privilege. So what is prepayment privilege? It means every lender provides you with the option to make some prepayments towards the principal of your mortgage so that you can pay down your mortgage early. So this column of the mortgage agreement will specify what those privileges are. So in this agreement, it particularly specifies that the buyer can make one or more lump sum payments each calendar year up to 15% of the original mortgage value. So 15% of $700,000, that is $105,000, can be paid each year towards the principal amount without any penalty. The second point here provides additional privilege to the buyer where he can increase the principal and interest payments by up to 100% at any time during the term of the mortgage, which means assuming the monthly payment of this mortgage loan is $4,000, so the buyer can make the monthly payments up to $8,000 without any penalty. And this increase in the payments is in addition to 15% of the lump sum payments. So a buyer can combine both these privileges to pay down the mortgage faster. So this section is very crucial when you are going in to sign the mortgage agreements. Make sure that you particularly ask about the prepayment privilege and also read through all the terms and conditions as well. After prepayment privilege comes the prepayment charges. So what if you need to pay even more than what your prepayment privilege has allowed you? So as per this lender, if you pay more in addition to your prepayment privilege, then the buyer has to pay a prepayment charge which will be higher of the two amounts, that is 3 months interest or the interest rate differential amount. So you need to check in your mortgage agreement that in case you want to pay down your mortgage even faster than what your prepayment privilege allows, what will be the prepayment charges taken by your lender. Next column is for the default insurance. In this case, the buyer is putting more than 20% of the down payment to purchase this property, so that's why it's not applicable. But if you will be putting less than 20% down, so all the mortgage default insurance details will be mentioned over here. So the mortgage default insurance premium gets calculated as per the percentage of amount that you are putting as a down payment, and that premium amount gets added to your mortgage loan amount. So most of the people just go through first and the second page of the mortgage loan agreement and they never bother about what is mentioned on the rest of the pages because it's a 17 to 20 pages lengthy paper. So if we dig deeper into that, there are more important terms and conditions mentioned into that, and you need to be aware of that before signing the documents. So now in this agreement on the third page, other fees are mentioned. So other fees may include your administration fee, means the fee that lender is taking to administer your loan. So in this case, it's a property appraisal fee the lender is charging, that is $300. Apart from that, whatever the fees that your lender will be charging in the future will also be mentioned. So if you check, here it is mentioned that in the future when the property will be discharged, there will be a discharge fee of $260, assignment fee of $260, or there can be a reinvestment fee if the mortgage loan is paid in full for any other reason before the end of the term, that is $300. So the actual fee that you are paying it now along with your mortgage loan and whatever the future fee would be is mentioned on this loan agreement as well. So just scrolling down to this agreement, what you need to check is advancing your funds. So if you see how much funds are being advanced to your lawyer for the closing, that is $699,700. So the actual mortgage amount was $700,000. So bank just deducted $300 their property appraisal fee, and rest of the proceeds are being sent to your lawyer, the closing purposes. Further going down, it will be specifying how much this mortgage loan will cost you. So since it's a fixed rate mortgage, your cost will remain the same throughout the term of 3 years. So it is $94,116.74 is the total interest that you will be paying for the term of 3 years. So digging deeper to this mortgage loan agreement, you will be seeing further more important terms and conditions. So if you see another important clauses, what fees apply if you don't repay the lender or fail to meet all your obligation. So for example, by any chance, if you miss your mortgage loan payments or are in default of your mortgage loan agreement, then the lender will charge you in this case all legal fees and cost on a full indemnity basis resulting from actions that the lender will take to collect any payments from you. So these are the important things that you need to read in your mortgage loan agreement as well. Going further in your mortgage loan agreement, what you need to check about is paying your property taxes. So the liability of the property taxes come along with the home ownership. But there are few cases where your lender takes the responsibility to pay the property taxes on your behalf. So when it is an insured mortgage, that is when you are putting less than 20% down, there are a few lenders in the market which enforce that the lender will be paying the property taxes on your behalf. So you need to check with your lender that whose responsibility it is to pay the property taxes to the municipality. Another most important term that you need to check and ask from your lender is taking a break from your payments. Life is uncertain. There can be some financial uncertainties that can come along the way, which can affect your ability to make your mortgage payments on the regular basis. So in that case, there should be having some privileges from the lender, which can give you short-term relief. So if you see in this case, the lender is providing the option of payment pause. In that, the buyer can skip a full or partial payment once per calendar year. So even such a relief will be handful for someone who is facing some financial difficulties. So make sure that you ask your lender that what options you have in case you face some financial difficulties in the future. So now let's move to the payments part, which I promised you to explain you in detail in the very beginning of this video. So one of the documents that you will be signing in your mortgage loan agreement is the pre-authorized debit agreement, which means that the payment of your mortgage will be taken directly from one of your bank accounts. So now if you check in this mortgage loan agreement, payment frequency is monthly. So one can choose from different payment frequencies starting from monthly, bi-weekly, weekly, semi-monthly, and there can be rapid bi-weekly and rapid weekly options as well if you want to pay down your mortgage faster. Because in the rapid options, you pay down one monthly payment extra each year. So if you see here, principal and interest payment is $3,936.82, and the first payment will be coming out from their account on October 1st, 2024. If you see here, the closing date is August 28, 2024. So from this date up to the first day of the next month, the bank only calculates the interest for the number of those days and charges you as your first payment. So the first payment technically to the lender is $353.47 on September 1st, and from October 1st, his regular monthly payment is gonna get deducted from his account. So in your mortgage loan agreement, you also have to check the first interest only principal that you are gonna pay and what will be your actual regular monthly payment that you will start paying from that onwards. So these were all the important terms and conditions that you should check before signing your mortgage loan agreement. Rather than relying on someone else's word, just go through all this document for 10 to 15 minutes. I hope I was able to enhance some of your knowledge about your mortgage loan agreement. Please subscribe to this channel if you want more knowledgeable videos in the future as well. Thank you.